All right, guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have an Ask Me Anything session with FuturesTrader71. The session is limited to 30 minutes. As you guys have questions, go ahead and start typing them right now, and we will try to get everyone's question answered today by FT71. The recording for this session will be posted in the AMA thread on BMT sometime later today. And with that, I will be turning things over to FT.
Let's see, let me turn on my charts. Just to have something visual. I'm going to start off because I'm a registered broker as well as a trader. I have to start off with a disclaimer, even though Mike had one on. You have to know that there's a significant risk to trading futures, options, and off-exchange retail instruments, and they're not suitable for all investors. Past performance is not indicative of future results. So what questions do we have today?
Okay, so let's jump right into it. Let's see. Ron wants to know if you will tell us how much size you're trading and what your scales, how big those are as well.
I'll pass on the size question because it really does not make a difference. I'll say that I'm a terrible one-lot trader. It's just because my method of trading involves managing risk with size, using theoretical averages and so forth, and that's probably something we can cover a little bit. But overall, I measure my performance based on a per contract basis. So I'm looking at on a decent trade, I'm looking to take about 2 points in the ES per contract. That's my goal. So my homework, my setups, my probabilities are all based on trying to get a 2-point rotation on average. And I do scale out, so that means I have to get more than 2 points. I have to find trades that are bigger than 2 points so that the average is about 2 points. But overall, don't get caught up on, you know, how big do you trade, how much money you make, and so forth. That's not really where the focus should go.
Yeah. All right, Lewis is asking, can you talk more about the different types of highs or lows? For example, sometimes you say something like weak high today.
Okay, very good. So this is the volume profile here, and again, the volume profile is nothing more than a histogram or a bar chart that shows horizontally what volume traded at each price. And you can have this for any product. Like here, this is another product that I trade a lot, the DAX. I have the same thing. I have a volume profile, and if I expand it enough, this software shows me exactly how many contracts traded per price. Okay, so that's what a volume profile is. Now, a weak high is one where, let's start by talking about a strong high. A strong high is one where prices have advertised so high that they are considered unacceptable, unfair, and therefore a seller will step in and just smack those prices down, smack the market down because they see an advantage in doing so, either by selling short or closing their long position. In either case, the motivation is that they don't believe that it's going to go any higher. So a weak high is one where the market makes a high and just lingers. Like this is somewhat of a weak high. A weak high combined with, see this pink line here, is the VPOC, or the volume point of control, or the most traded price for the day. Right now it's sitting at 66.75. If I have a combination of a weak high plus the VPOC is near that high, generally, based on just statistical research, that this high has a low probability of standing. So on pretty much any day you look at, whenever we leave kind of a blunt high, the market tends to go back and revisit, and it tends to leave a tapered high, which means as prices went up, participants lost interest. The only reason the market would create a blunt high, we created a blunt high a couple weeks ago and left it up there. It was a day where we opened and just dropped right off. See if I can find, right here. See this day here? We opened, we touched the high, we traded a lot near that high. And see that? We traded a lot at that high, and then the news came out about Cyprus, and it just trended down for the day, and we left this blunt high or weak high. See that? It's flat. It should be, a normal high is generally tapered, and on a 3-minute candle or something, it looks like a long wick, and the market just rejected those prices. That's a strong high. A weak high is just one that the market just traded and traded and traded. And for every buyer in futures, there's a seller. There's no inventory of stock like in a stock market. Futures are contracts between buyers and sellers. So there are never more buyers than sellers in futures. That does not exist. Okay? And in futures, you can generate as many contracts as there is interest. So there is no float or a limited number of shares that a company puts out. So knowing that in order for this to be a blunt price or a high volume price at the high, there had to be a lot of buyers coming in to buy, and there had to be a lot of sellers coming in to sell to them. Otherwise, there would be no trading there. And if the high was considered unfair, why did it trade so much? And so generally, a weak high is one where I don't automatically think, oh, the high is in. I generally am suspicious of a weak high, and if you watch them over time, you'll see that pretty much, 8 out of 10 times it will get taken out by the end of the session. So this here does not give me confidence to go short a full unit looking for, for us to drop. Today has been there's been some very odd trading in that the transports and other underlying products are much weaker than the market, yet this market keeps making new highs. And my suspicion is we'll make another high here. We'll take out the 68. But in the end, I think by the end of the day, if I had to guess, I would say we would finish lower into the close. There's just a lot. If you look at the S&P breadth, the S&P breadth has been nothing but down since the open. The S&P breadth measures the positive and negative issues for the day. When I look at transports right here, they're not making new highs. So the day started right here. Transports are trading below the mid, below yesterday's low. So to me, I'm suspicious of these highs. I know it looks like a trend, but it isn't a trend day yet. So anyway, I hope that answered your question.
Okay. Mark asks, was today a open rejection reverse or a open auction in range?
It's an open rejection reverse because it opened, tried to go down, and then someone came in and said, too cheap, take them back up. And so the initial move was rejected. It reversed, and then it just kept getting higher and higher and higher. Note that it did not test the open from above yet, and it just kept going higher and took out yesterday's high. Once I saw that open, by the way, the 60.75 put in, and it just went back up and crossed the opening price, which is this dotted green line. There's so little volume from yesterday up here against 5-year highs that the short is just low probability all the way. And if you want to see an example of an amazingly great weak high, just go back one question. If you look at, let's see, begin to end. If you look at where we were at 8:47 this morning, what the profile looked like, you'll see a very weak high. So today, it just, see this, let me stretch it a little bit. See, that's another example of a weak high. So for me, it was hands off the shorts this morning. It rejected any test lower. Most of yesterday's volume is below. Here's where yesterday's volume was, and this was a thin, what I call an LVN zone, or a low volume node zone. And it's just put in these weak highs this morning. Tap, 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 tap. The probability of the market holding this high after so many tests is very, very low, although many will argue that multiple tests, like a double top, a triple top, and so forth, shows strength at that top because it's not able to take it. My studies show the opposite. The more times we test a level, the more likely it's going to crack. So this morning showed a lot of weakness, and I did classify it as a open rejection reverse.
Okay, Arnie says, wait for confirmation or anticipate?
No, don't anticipate. Don't anticipate. As a trader, the only time you can anticipate something happening is if you have some strong odds or strong probability of it happening. For example, the overnight high 63.75. If we opened in range and started to head in the direction of the overnight high, given the overnight high or low breaking 96% of the time in the S&P during the day session, that's a high probability. That's something I would anticipate. But something like this, anticipating or trying to trade within that first 15 minutes in an area that had no real volume from yesterday or no action from yesterday, it's to me it's more like gambling unless you're a scalper. So I wouldn't don't anticipate. Right. Just read the market. It says the story.
Okay. Mike is asking, when you say in the mornings you expect responsive buying or selling on the open, what tips can you offer to that?
So the market had, yesterday was a special session because it was a holiday in Europe. So it doesn't count as a full session, but when I move to a 15-minute here, the market trades in the morning, and you have either buyers or sellers pushing it in one direction or the other, or you have balance. Balance only exists because both buyers and sellers agree on those prices. And so if they agree on prices, yet overnight we move away either much higher or lower, generally what I'm looking for is responsive activity. So what does that mean? It means that if we gap up above the value of yesterday, especially if it's above the range of yesterday, then sellers are what I expect. I expect the market to seek balance all the time, and the last balance we had was yesterday's balance. And if it's below, then responsive or moving towards balance would be selling. If it gapped below, then I would say expecting responsive buying back to balance, because I expect that the market will try to go back and check to see, is this price that was accepted, this price range that was accepted yesterday, is it still in effect, or are we going to move away from it because we're pricing something new? So that's what responsive buying or selling is. Okay.
Stephen is asking, how can you expand on how you use the VWAP?
Okay, the VWAP, I have it on here. I have it on here because I know that it's a benchmark for a lot of trade desks. I mean, a lot of your trade desk performance is measured by how well you executed a large order versus VWAP. And so I know that a lot of times the market has a reaction of VWAP. I do not use it to initiate a trade, but I use it in case, let's say I'm short here. I will try to scale out before VWAP because I expect that there's going to be some volume taking place or some action taking place ahead of it or around VWAP, and I don't want to get caught in that. So I'll generally scale out before VWAP. Same thing with the mid. The mid generally gets a reaction like you see here today. VWAP and mid behave sort of the same, except I will initiate at the mid, but I will not initiate at VWAP. So for me, VWAP is just a place where I exercise caution if I'm heading into it.
Okay. And just so everybody knows, we're currently at the halfway point, and I am asking questions that were typed in about 2 minutes after we started the AMA. Okay, Chuck is asking, when the market is making new highs, what levels do you lean on to trade?
So because I don't have volume, I'm using IQ Feed, which I think is the best data feed out there that you can actually buy that is affordable. Their data, because they don't package data and send it, buy someone's data and give it to you, they only work with their own. They only started collecting data on September 5th of 2009, I think, or 2005. And so I can't get any more data from them for the S&Ps before that. So my composite, as you can see here, this composite involves all data that's available. It stops at new highs, so I cannot rely on volume profiling for higher prices. So instead, I use traditional methods. I use something like, let's see, I'll use measured moves. I posted one on Twitter this morning. We just took one out the other day that was at 62.75. I announced a couple days ago or last week. So what I do is just use traditional methods like, patterns, cup and handles, head and shoulders, inverse head and shoulders, but my preference is to use measured moves. And right now the measured move that I'm watching is from the low at the beginning, on the first day of the year to the high in February, projected from the low made at the end of February out, gives me 69.25 as the next area I expect the market to pause. So I just use measured moves, 100% projection, and then and you can use those on many different time frames. I can do it in intraday, or I could do it long term. I use it for long term only.
Okay. You already answered this quite a bit, but Merritt is asking if you can expand on today's analysis, anything you see unfolding. You want to add anything to what you've already said?
Yeah, I've said what I wanted to say. I mean, just looking objectively at what, the futures are based on some underlying product, and the underlying product is, in my opinion right now, not supporting these prices up here. Even the cumulative tick, when you look at the cumulative S&P tick since the beginning of today, what you see is that, so today started right here, and you see at the beginning it expanded up from the zero line faster than it did down, but then around 9 o'clock after the factory orders and IBD tip numbers came out, it started to expand lower, yet prices were not going any higher. And so this chart, this bottom pane here, shows the cumulative tick, or the sum of all of these tick closings, and I'm using a 15-second chart. It shows it negative for the day, yet prices are near highs. Same thing with transports. Transports are trading inside of yesterday's range, below the mid. Look at them. They opened somewhere up here, made new highs with the new highs, but then at 9 o'clock, once that number came out, it went lower and has stayed near the lows. Same with, and those are the big ones that I watch, same with S&P breadth, just unable to maintain. As soon as we open, it made a new high, and then this is the opening price for the S&P breadth. This is like the advanced declines, but I'm only looking at S&P 500 stocks. I'm not interested in the entire New York Stock Exchange complex because it doesn't affect the S&P as much as this does. This shows that we're below the mid. We keep pushing newer lows, but the S&P is making newer highs. So to me, I find today's action odd. It's not supported by the underlying, which tells me that there's a buying program in there, and eventually I would expect it to end, and I would expect the prices to kind of fall back in line. Either the underlying is going to come up to the futures, or the futures, I expect the futures to to drop back towards the mid, probably down to the 63, 62 range into the close, if not lower.
Okay.
So I think it's overpriced right now.
Okay. Dev is asking, what's the best way to make sure that your view is not affected by your position? For example, not willing to exit a trade because you're not in the money or rush out to lock in P&L.
Okay, if I could scream something at the top of the Himalayas for the whole world, trading world to hear, is don't look at your P&L. Your P&L does not mean anything while you trade. Don't do it. Your trades are not based on how much money you're up or down. Just because you're up $200 or $400 does not mean you should take more risk and trade more. That is your money. You earned it. If you're down for the day, that does not mean that the outcome of the next trade is going to be another loser. So you should be scared to take the next legitimate setup that's coming up. The only reason your trading is affected by your position or your P&L is because you have your P&L on your screen and you're trading your P&L. Unfortunately, the market and prices are not based on you, Dev, your individual P&L. It's based on market structure, the auction, and supply and demand. That's all it is. So your P&L does not factor into anything except to your personal emotions. So don't watch your P&L. It's just not smart. It causes you to get emotional, to take steps. And by the way, many, breed Brett Steenbarger. I mean, a lot of this stuff has been studied over and over, and it shows that there's a strong force within your mind that wants you to act when you see danger, and a negative P&L is danger. So it's hard for you to counteract that. That is what, as a prop shop owner, as a guy who's trained traders and so forth, that is what you focus most of your time on, stopping people from trading their P&L. So don't watch it. Don't look at your dome once you put a position on. I don't look at my dome once I put a position on. I want to stay, I initiated the trade not based on what's going on in the dome, but based on what's going on in my chart and the context or the story that is unfolding. And so once I put a position on, I don't want to look at the dome. I don't care if it's, 567 bid by 551 or whatever it is now. It makes no difference to me. What I want to see is how is the chart reacting. I've already defined my risk. I know that if the chart starts walking towards my risk, that I'm going to get stopped, but I have to let the trade play out. So once you put a trade on, and this is really important, once you put a trade on, your trade management scheme, in my opinion, should be fixed until you're very consistent and have a good flow with the market. And just let the market play it out, because if you start interfering with how you manage a trade after you put it on, then you're creating randomness within a random entry. It's not something you can resolve. It's not resolvable as a way to grow your trading or define how you can improve your trading style. It's very, very important to kind of come to terms and know that this is what is happening.
Right. Okay. Nat says he's using TradeStation and Interactive Brokers for his platforms and software, and he wants to get your setups, your templates. How can he do that?
You can't. I don't know of anyone who's taken. First of all, TradeStation does not give you tick data, tick volume data. It's aggregated data, so you're not going to get a volume profile that represents the shape of what actually happened. They don't have volume profiling in their platform, so you would have to somehow create that or have someone create it if that's possible. It's, to me, if you're trading futures, you really need to clear through someone, and obviously I'm a member of a brokerage and so forth, so I have a strong bias because we're trying to build something that is special and so on, that has the best tools affordable to traders. But IB is the same. It's aggregated. It's pulse data. It's not intended as a platform. It's intended to cover such a broad market, just like TradeStation does, that it's not really designed just for futures. Same with Thinkorswim and so forth. So it's different it's different when you're using data and a platform and so forth that is just built for futures, so to speak. So I can't suggest something for IB and TradeStation. I've used both of those. I don't like them. I wouldn't trade my futures account on them, but I understand why people have them, because they want to trade stocks and so many other things.
Sure. Scott is asking, when the VPOC changes during the day, up or down, how do you change your trading plan for the day?
Okay, so it depends on context. Again, context is a very elusive or big word, but it depends. Did the VPOC shift on a double distribution profile, and then did the market then start selling? If it did, then I'm looking to short into, let's say let me draw it on here. Let's say we have something that looks like this and this, and the VPOC goes from down here to up here. And as soon as it does, and the only reason it does is because there are a lot of sellers and a lot of buyers trading at a price that caused that shift. As soon as it does, if prices start going down to that thin part for that bottom distribution, that's an interesting point for me. I'm looking to buy that back. If it fails through and I lose on the trade, then the target is going to be wherever VPOC was before. So I'm going to be looking to find a short that would take me to the bottom distribution. That's one method. If the profile is cut off right here and it's got a big long bar, and VPOC moves from somewhere below or the middle to the high end like it is now, and the high is right here, then there's a high probability the market's going to extend, and then the profile is going to level out more, taper off more. So I'm going to stay off shorts. The awareness that I should stay off shorts is as valuable to me as the awareness that I should get long, because it keeps me, saving money is the same as making money, So to me, it just depends on context. Every VPOC move has its own context.
Okay. Only a few minutes left. Mark asking, do you have any concerns or see any evidence that discretionary volume profile support and resistance is endangered by the algos? Do you feel that this style of trading is robust for the future for someone trying to build a business on it now? And he also wants to know if you employ any algos in your own trading.
No, I don't employ algos in my own trading. It's robust simply because it's built on what the market is. An algo either has the purpose of executing a large order by hiding it in the form of icebergs, bid offer flips, things like that, or an algo has a statistical edge and executes when that edge appears every single time. However, the edge does not appear without some sort of human intervention or human participation as to what value is. So let's take a moving average crossover system. Well, the moving average crossover system might kick in when the moving averages cross. But what makes the moving averages cross? It has to be a perception of value, and it has to be based on the auction. You cannot lose in the form of, not in the form of trading or P&L, but in the form of knowledge by understanding how the auction works. Because even if you're out buying a house or you're pricing a car or whatever, it's the same auction principles that govern how that price is determined. Anything that has a price tag on it, including your collection of baseball cards or whatever, is based on the same exact principles. Okay, so auction, looking at volume profiling and what the auction's doing, I can't see that as a losing proposition of your time.
Okay. Dan is asking, do you have any link for money management suggestions? So do you have anything that maybe a past video or anything like that you could point to?
I would have to dig that up. I would suggest you ask that question in the AMA thread, and I'll try to dig something up for you.
And if you go on BMT in the webinar section, you just did, I think your last full webinar was actually on trade management, so that's probably a pretty good place to start as well.
Yes, yeah, that's the trading, managing the actual trade, but I did talk about money management in the past, I'd have to just look
Yeah.
at one of my free chats for that.
Okay. All right, and we're at 30 minutes, so I want to go ahead and stop at this point and try to keep these as close to 30 minutes as possible. I'll post the recording for this sometime later today in the AMA thread. For anybody that did not get their question answered, you can ask it in the AMA thread, or we'll be back in a couple weeks with FT71 again. So FT,
Thanks so much for having me, Mike.
yeah, thanks always. Thanks as always. I appreciate you coming on and giving us your time, especially in the middle of a live trading day.
Thank
All right,
you,
guys.
folks. Take care.
See everybody next time. Bye.